Welcome back to the Deep Dive. This is your essential briefing for September 19th, 2025. And today we're cutting straight to the chase. Bitcoin, well, it's in this state of, let's call it constructive consolidation. But this isn't just any consolidation, right? It follows two, frankly, massive tailwinds. We had the Fed's big dovish pivot, a clear signal for markets. And then almost simultaneously, the SEC drops this landmark approval for a new streamlined framework for crypto ETPs. I mean, these are potentially landscape-altering events. So our mission today is really twofold. Isolate the immediate signals, that technical battleground for Bitcoin's price, and crucially, break down the complex new risks, things bubbling up in the institutional space, corporate treasuries, even mining.
Exactly. And that precision is, well, it's vital for you right now, because if you look closely, the market is, it's sophisticated. It's showing two faces, really. On one hand, yeah, there are clear short-term opportunities. You can see the liquidity building. But on the other hand, you look at the institutional side, the corporate moves, the mining geopolitics, and there are some pretty serious long-term systemic warnings flashing, execution risk, supply chains. It's definitely a high-stakes moment.
Okay, let's unpack this then. Starting right at the price. Bitcoin is holding that critical $116,000 level quite firmly, currently trading, around $116,300. It's really testing resistance, mostly bouncing between $116,000 and just under $170,800. It's a tight range.
It is, and it's more than just sideways action. It's a real standoff. The technical levels are, well, they're pretty clearly defined now. That primary battleground, the zone everyone's watching, is definitely $117,000 up to $117,800. Analysts seem to agree what we need, the trigger, is a sustained daily close above $117,800. If we get that, that's the catalyst, the signal that bulls have likely won this round, and the path to $120,000 buttons up.
And the floor. Where's the immediate support?
Immediate support is right around $115,500, but maybe more significantly, $114,600. And it's worth noting we are seeing some, overbought readings on certain indicators, particularly on the daily charts, that actually suggest that some consolidation, maybe a dip towards that $114,600 level, might not be a bad thing. It could be healthy, necessary even to reset momentum before another leg up.
Right, that makes sense. And this tension, it's perfectly captured in the forecast floating around, isn't it? You've got very different views. On one side, Axel Adler Jr. being quite bullish short-term. He's putting, a 70% probability on a new all-time high within 2 weeks?
Yeah.
Based on on-chain stuff like the MVRV Z-score?
Yeah, the MVRV Z-score for short-term holders is near zero.
Which, for people maybe not familiar, basically means the market isn't extremely overheated with everyone in massive profit, nor is it deeply oversold. Kind of coiled, right? Ready for a move.
Exactly. But you absolutely have to balance that short-term tactical view with, say, Benjamin Cowen's long-term perspective.
Yeah.
He's always reminding us about cycles. And he points to history, past cycles saw drawdowns of, 77%, 87%, even 94%. So he's warning that even if we hit a new high, a 70% drop from that next cycle peak is, historically speaking, very much in the cards. It's a sobering reminder of volatility.
Okay, so if $117,000 is such a heavy supply zone, as you mentioned, people bought there, isn't Adler's 2-week time frame maybe a bit optimistic?
Right.
Even with all that capital waiting?
It's a fair question. And the on-chain data, it does back up that caution. Glassnode confirms it. 117K isn't just a line on a chart. It's a level where a really significant chunk of Bitcoin supply last moved. So it's a real barrier defined by actual holders. You're asking people who bought there to either hold patiently through consolidation or sell for maybe only a small profit. That takes conviction.
But the counter-argument is the sheer firepower waiting.
Precisely. That's what gives the bulls hope. CryptoQuant's numbers are pretty staggering. They're reporting token reserves, BTC, ETH, stablecoins on just Coinbase hitting $112 billion. That's a 4-year high. And that $112 billion, it tells a story. It suggests serious institutional capital is parked, patient, on an exchange they trust, basically waiting for that green light, that technical signal to jump in. It's like a massive coiled spring ready to deploy.
And we're maybe seeing the first twitches of that spring in the ETF flows. I mean, after that little blip, that $51 million outflow on the 17th, probably just profit-taking after the Fed news excitement, we saw a very decisive swing back. Positive territory immediately.
Yeah, strong signal.
The specific number was positive net inflow of $163 million on September 18th. For the U.S. spot Bitcoin ETFs combined. That's a quick, sharp reversal.
It is, and it's significant, I think, because it really validates the main thesis out there, that sophisticated investors, the institutional players, they see the Fed's dovish pivot not just as a quick trade, but as a genuine long-term tailwind for scarce assets like Bitcoin. And importantly, that one-day lag you mentioned, between the Fed announcement and the big inflow, that suggests a very deliberate pattern. Institutions analyze, then they allocate. It wasn't just a knee-jerk reaction. It actually makes these daily ETF flows almost like a high-frequency indicator of how macro sentiment towards Bitcoin is shifting in real time.
Okay, so that's Catalyst 1, the macro and the flows. Now, Catalyst 2. Here's where it gets really interesting, I think. The SEC's new streamlined ETP framework. People are already calling this the ETP Floodgate for potentially a whole range of other tokens.
And that floodgate analogy, it actually holds water if you look at history. Matt Hugin over at Bitwise drew a parallel to traditional equity ETFs. When similar generic standards came in years ago, the number of new product launches nearly tripled, jumped from about 117 a year to around 370. We could genuinely see a similar explosion of new crypto ETPs hitting the market.
But there's a catch, right? Who gets through the gate first?
Yes. The rules themselves define the new gatekeeper, essentially. The framework requires that an underlying asset must have had a futures market trading on a regulated exchange like the CME for at least 6 months. So the CME effectively becomes the first hurdle. If your token doesn't have CME futures, you're not getting an ETP under this fast track, at least not yet. Galaxy already crunched the numbers. They identified 10 tokens that currently meet that criteria. Besides Bitcoin, you've got Solana, Dogecoin, Litecoin, Chainlink, Stellar, Avalanche, Shiba Inu, Polkadot, and Hedera.
So that's the initial list.
That's the initial list that qualifies right now. It's a massive structural shift because it creates a clear, regulated pathway, but also a clear dividing line. Altcoins not on that futures list. They're sort of on the outside looking in, for now, cut off from this potential wave of institutional ETP money until they get those regulated futures contracts listed. Cardano and XRP are apparently close, expected to meet the criteria soon, but, timing is everything in these markets.
And even as this potential floodgate opens, the SEC is signaling they're not just rubber stamping everything. They've specifically instituted proceedings to take a closer look at that proposed Truth Social Bitcoin ETF, ticker BT.
Right. And singling out that particular ETP, one with clear political affiliations, it suggests the regulatory scrutiny isn't just about the underlying Bitcoin anymore. It's expanding to include the, let's say, the nature and branding of the ETP sponsor itself. It implies that if you're a controversial or maybe politically charged sponsor, you might face a higher bar, more questions. The SEC seems to be testing the waters, looking at operational and reputational risks tied to these non-traditional issuers before the product even gets close to market.
Interesting. Okay, let's shift gears slightly away from pure market structure to corporate adoption. We're seeing an evolution there too, aren't we? It feels like we're past that initial phase one where companies just bought Bitcoin and held it. So that worked out well for some, like ProCap BTC. They bought in June 2025, saw over $60 million in unrealized gains. That certainly validated the early strategy.
Absolutely. That validated phase one acquisition. But phase two, it seems, is all about diversification and, crucially, generating yield. Active management. The most dramatic example has to be the soulmate pivot. You had BREA Holdings, their stock just exploded up over 200% after they basically reinvented themselves. They became Soulmate, a Solana-focused treasury company. And this wasn't just a press release. It was backed by a serious $300 million PIPE deal. Private investment in public equity. ARK Invest was even involved.
So they raised $300 million to buy Solana.
Primarily, yes. But their strategy isn't just holding the SOL, it's actively staking it to generate yield, targeting somewhere between 5% and maybe 8% annually. That's the new template emerging. Hold the asset, but also make it work for you through staking or other yield strategies.
But hang on. The stock jumps 200% because they're holding Solana and staking it. Yet you mentioned their market cap is still below the $300 million they raised. That seems off. Why the discount?
That discount is fascinating. It's the market basically saying, okay, great idea, but can you actually pull it off? It's pricing in significant execution risk. Or maybe we can call it a managerial competency discount. Investors are asking, can this management team actually build and manage the staking infrastructure securely? Can they handle the operational complexities and risks of high-yield digital assets? The focus shifts from just the potential of Solana itself to the perceived ability of the Soulmate team to execute the plan and protect that capital.
So it's not just about the asset, it's about the operators.
Exactly. And we're seeing a different flavor of this, maybe a more cautious approach, over at Amazing AI Policy in London. They updated their treasury policy, too, But they're aiming for a diversified basket up to 5 established crypto assets, potentially including Ethereum. But look at their criteria. Minimum $500 million market cap, minimum $50 million daily trading volume. Very strict. It feels like their board is focused on risk management. They're not chasing meme coins. They're building a diversified crypto portfolio focused on liquidity and size, something a more traditional CFO might actually be comfortable with.
Right, managing the risk. Which brings us neatly to the mining sector, where risk seems to be escalating rapidly, particularly geopolitical risk.
Yeah, this is a big one. While corporations are grappling with asset and execution risk, miners are facing a potentially existential threat from geopolitics. U.S. Representative Zach Nunn has formally asked CFI-US, that's the Committee on Foreign Investment in the U.S., the body that reviews deals for national security implications. He's asked them to investigate 2 dominant China-based mining hardware giants, Bitmain and Cango.
And the concern is,
It's about opaque corporate structures and potential links back to the Chinese government, national security concerns. If CFI-US decides to act, maybe restricting imports or imposing tariffs, it could genuinely bifurcate the global mining hardware market. Think about it. U.S. miners are heavily reliant on Bitmain and Cango for the latest, most efficient machines. This is a potential systemic shock to the economics of the entire U.S. mining industry. Huge implications.
wow, okay, so a major potential disruption on the supply side. Yet, ironically, the tech itself keeps pushing forward. Bitdeer just launched their SealMiner A3, another leap in efficiency right when the supply chain might fracture.
Exactly. Innovation doesn't stop, but what's even more interesting is where miners are redirecting that technological expertise. They're pivoting hard towards AI, leveraging their data centers, their cheap power contracts, their cooling know-how to get into high-performance computing, HPC, and AI cloud services, and the market loves it initially. We've seen stocks of miners making serious AI plays jump 60% or more.
But is that sustainable? Does that managerial competency discount apply here too? Building AI infrastructure seems wildly different from running mining rigs.
It absolutely applies, maybe even more so. Take Niscale, for example, an AI infrastructure company spun out of a crypto miner. They landed massive contracts, supposedly, with giants like Microsoft and NVIDIA. Huge potential. But the market is deeply skeptical about whether they can actually build out the infrastructure, get the chips, deploy the racks at the speed and scale required by those contracts.
It's not just plugging in miners anymore.
Not even close. Building cutting-edge AI data centers is incredibly capital-intensive, operationally complex, and needs to happen at lightning speed. It's a massive execution challenge. And this creates a real valuation dilemma. The market is treating these transforming miners like high-growth tech stocks, giving them these premium multiples based on the AI dream. But is it potentially creating a bubble by ignoring the immense execution risk of the AI pivot and forgetting the cyclical commodity-like nature of their underlying legacy mining business? It's a risky blend.
So what does this all mean? Wrapping things up, we've got these incredibly strong fundamental tailwinds, right? The Fed's liquidity, the institutional access via ETPs, that's undeniably bullish. But the market is clearly shifting into a much more nuanced, complex phase. It's less about just the price of Bitcoin and more about these sophisticated structural risks, geopolitics, regulation, and this huge question mark over execution and managerial competence.
Couldn't agree more. For you, as an investor navigating this, there are probably 4 key things to watch very closely right now. First, obviously, the outcome of that $117,800 price test that dictates the immediate direction. Second, keep a close eye on the consistency of those daily U.S. spot ETF inflows. Is this institutional conviction sustained, or was it just an initial reaction? Third, watch the SEC. How quickly and in what manner do they respond to the first wave of altcoin ETP filings, Solana, Dogecoin, etc., under that new framework? That sets a precedent. And finally, any official word or movement from CFI-US regarding that probe into Bitmain and Cango, that could fundamentally reset the mining landscape, especially in the U.S.
Okay, lots to track. And a final thought for you to chew on. As we see companies like Soulmate or even Amazing AI creating these hybrid models, blending volatile digital assets with really high-risk operational pivots like staking or building massive AI data centers, how is traditional finance ultimately going to value these things? Are they tech stocks? Are they commodity producers tied to energy prices? Or are they something entirely new where the value hinges almost entirely on whether management can actually deliver on these ambitious, complex plans? So that valuation puzzle, how the market solves it, that might just define the next chapter for this entire space.